Welcome to the Daily Drawdown, your brisk brief on the tech reset, AI spending, and fresh market supply. The market finally hit the part of the trade where crowded winners stop acting like they can only go up. Tech got hit hard. Yields pushed higher, crypto cracked, and a new wave of equity supply is starting to matter. The headline move was the Nasdaq's record one-day point loss, roughly 1,100 points, with the Nasdaq 100 down about 4.3% in its worst session in more than a year. The immediate spark was Broadcom. Weaker guidance and earnings were enough to break confidence in a chip complex that had gotten extremely stretched. That unwind spread fast through memory and semiconductor names, with sharp double-digit percentage moves in stocks like Micron, AMD, Western Digital, Marvell, and Intel. Why it mattered is the setup. The semiconductor trade had become a classic momentum pile-in. The SOX had been cited around 70% above its 200-day moving average, and a lot of these names were still up 150 to more than 200% from the March lows. When positioning looks like that, you don't need a disaster, you just need a reason to take profits, and then options activity and record volume do the rest. What to watch next is whether this stays a contained de-risking in crowded AI and chip leaders, or starts dragging in the broader index through passive flows and hedging. The macro backdrop didn't help. May payrolls came in stronger than expected at 172,000, and that pushed two-year yields to multi-month highs while the curve flattened. The practical effect is simple. Stronger labor data makes the Fed less likely to rush into cuts and raises the odds of either a later easing cycle or even another hike if inflation refuses to cool. Analysts also flagged 4.75% on the 10-year as an important line. If yields push through there and hold policy expectations and equity valuations both get a lot less comfortable. That's showing up in positioning already. There's clearer rotation into healthcare, energy, real estate, and staples, while high-beta tech and consumer discretionary are being trimmed. This matters most for investors who assumed AI leadership could ignore rates forever. It can't, especially when profits are being taken and fresh equity supply is coming. None of this means the AI build-out has stopped. The opposite, actually. Google, Amazon, Microsoft, and Meta are still expected to spend enormous sums on AI capex this year, with estimates running into the hundreds of billions collectively and some forecasts going even higher next year. The important point is that the market still tends to underestimate the second-order spend. Hardware doesn't sit alone. It pulls through software, training, workflow changes, and power infrastructure. There are also local economic effects. New data centers can boost nearby county GDP, which is one reason utilities, industrials, and infrastructure names remain tied into the AI story, even when software and semis wobble. Inside enterprises, adoption is moving quickly. DocuSign said AI is now helping write about 75% of its code, up from about 60% a quarter earlier, and it highlighted proprietary contract data as a durable advantage. That gets at the real battleground. Not everybody wins by building the biggest model. A lot of the value sits with firms that own the workflow and the data. That's also the lens on Apple going into WWDC. Expectations were for incremental, monetizable edge AI features, like better on-device search, stronger Siri request handling, and partnerships, including reported use of Google's Gemini, rather than Apple trying to brute force a giant frontier model of its own. Why it matters is distribution. Apple has roughly 2.5 billion iOS devices in the installed base, so it doesn't need to win on raw model scale to win economically. The bull case is that Apple becomes an AI toll collector, embedding useful features across devices and services and monetizing the installed base instead of competing head-on in the most expensive part of the race. The next big market variable is supply. SpaceX is planning a $135 per share IPO with a very small initial float, roughly 4 to 5%, and up to around 30% of the deal reportedly reserved for retail. That sounds exciting, but tiny float cuts both ways. It can create a sharp pop on scarcity, then leave the market exposed to later supply shocks as lockups expire and secondaries arrive. Brokerages are already lowering retail minimums in some cases, but they're also using anti-flipping rules, including short lockups or penalties like future IPO bans, to keep that first-day churn down. Index mechanics matter here too. S&P won't fast-track the stock into the S&P 500 because the usual earnings and public float filters still apply. NASDAQ is different. Its inclusion path can be faster, and if SpaceX gets quicker NASDAQ exposure, that creates forced demand from index and ETF buyers sooner than an S&P path would. The bigger issue is the wave behind it between SpaceX, possible Anthropic or OpenAI activity, and secondary offerings from large tech names like Alphabet. The market could face a very large slug of new equity supply. The debate is whether that supply simply provides liquidity for eager buyers or whether it starts absorbing money that had been propping up expensive public leaders. On policy, the AI debate is getting more serious and more awkward. Reports say U.S. policymakers have discussed unusual options, including potential equity stakes in major AI firms, alongside bipartisan efforts to build guardrails without choking off innovation. Proposals on the table include federal standards around national security and cyber risk, state-level deployment rules, and review mechanisms with sunset clauses. At the same time, the industry is arguing with itself. Anthropic's call to slow frontier model development was welcomed by safety advocates and dismissed by critics as strategic positioning. The reason the policy fight stays messy is that timelines are all over the place. A lot of insiders still do not think recursive self-improvement or AGI arrives in months, which makes it harder to calibrate urgency. In labor markets, the evidence is mixed but real. Some less experienced white-collar roles are getting squeezed, while some firms adopting AI are still hiring. Near-term gains can reduce demand in specific jobs, even if longer tech cycles create new categories later. Elsewhere, crypto is trading like risk, appetite has weakened. Bitcoin dropped below 60,000, liquidations were heavy, ETF outflows piled up, and options positioning turned more defensive with puts outpacing calls. That matters less as a standalone story than as a read on leverage and speculative demand across markets. Technical risk indicators are also flashing hotter than usual. The S&P's weekly RSI has been cited near extremes not seen since 2000. Options volume hit roughly 109 million contracts in one session, and heavy put buying in bond. ETFs suggest investors are actively hedging rate risk. One more watch point is energy. U.S. crude inventories are low. China reportedly has a much larger reserve cushion, and analysts are warning that any geopolitical disruption, including around the Strait of Hormuz, would hit Asian importers especially hard. A few quick closes. NVIDIA's $80 billion buyback and higher dividend were taken as confirmation that AI demand is translating into real cash generation, even while the broader chip group is showing more earnings risk. Boeing is still trying to ramp 737 MAX output and expand capacity, but supply chain bottlenecks in areas like engines and seating remain a constraint on how quickly that turns into cleaner cash flow. And some of the more speculative AI-adjacent ideas, including solar-powered orbital data centers tied to SpaceX, still look exactly that, speculative, with major technical, logistical, regulatory, and power hurdles. That's the setup right now. Crowded tech, unwinding, rates staying live, AI spending still huge, and supply becoming a market issue of its own. You're listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.
Podkey.